Hey everybody, this is Quiz Access Chapter 11, number 5. And so I'm just going to work through it. I think I have found a couple little errors in this that I know we've reported to McGraw-Hill in the past, and I'll report them again, but maybe this will help us work through those, the little error here. There's not a lot of errors in McGraw-Hill. Like usually their stuff's pretty good, but looks like we've got a couple little issues. So let's just work through it. So the following are the issuances of stock transactions, and then it asks us to analyze each transaction by showing its effect on the accounting equation. So let's just go through it. So here we have the corporation issued 3,000 shares, $20 par value common stock for $72,000 in cash. So I'm actually, I hate this scrolling business too, and I'm sure you do too. I'm going to start over here on the equity side. I'm going to say common stock, $20 par value. And that's going to increase my equity. And that will increase it 3,000 shares times $20 par value, which will be $60,000. And it looks like we got 72,000 in cash. So we can't just list the par value. It looks like we have also gotten some paid in capital in excess of par value on our common stock. That'll also be an increase to the equity. And that will be, if the par value was 60,000 and we got 72,000, then the capital in excess of par value is 12,000. And so now you see the reason why I waited to deal with assets is I wanted to add up the total of that. So we got 72,000 total in cash. So I'm just going to say this was an increased cash of $72,000. There's our first one. Number 2 says a corporation issues 1,500 shares of no par common stock to its promoters in exchange for their efforts, estimated to be worth $37,500. The stock has a $3 per share stated value. So again, here we're not getting cash. Instead, we're exchanging the stock for it looks like promotion or advertising expense. So the way this is going to impact us here is we have 1,500 shares of $3 per share or stated value per share. So I'm first going to decrease my equity just by listing what's called an expense. They call it organization expense here. And that would be the full amount, which was $37,000. Oh, wait. Yeah, $37,500. So that'll be a decrease to our equity because that's an expense. And then we can do the entry for if it was 1,500 shares of $3 per share stated value common stock, we'll actually list the stock here as common stock, $3 stated value. This will be an increase to our common stock account. It was $3 times 1,500 shares, so 3 times 1,500 is $4,500. And then finally, since we got $37,500 worth of value from this, then any difference between what the stated value of the stock was and the value we got is going to be paid in capital in excess. And really, this is where I think I found the error in the system. So what we should be putting is paid in excess capital in excess of stated value on the common stock. But I found this error in McGraw-Hill that I'll report, and they want you to put paid in capital in excess of par value. So this is wrong because this is no par stock, right? It already told us that, but that's what they want from us. And so it's going to mark it wrong if we don't put that. That's going to be an increase to our equity, and it'll be the difference between those two, which should be 33,000. So what we have going on here is our stock has a $4,500 stated value and $33,000 paid in capital in excess of that stated value for a total of $37,500. And then it's paying for an expense, in this case, the advertising or marketing costs. So number 3, the corporation issues 1,500 shares of no par common stock to its promoters in exchange for their efforts, estimated to be worth $37,500. The stock has no stated value. So this one looks kind of exactly the same as the last one, except there's no stated value. So here, we're just going to say organization expenses. And that will decrease our equity, 37,500. And then we'll say common stock, no par value, which will increase. And then our last one, corporation issues 750 shares, $50 par value preferred stock for 75,000 cash. So again, we're just going to put preferred stock. $50 par value. Let's see, how much was it? 750 shares times $50 par value. Bring up a calculator here, which is $37,500. And then how much did we get for it? 75,000 in cash. So we'll say 75,000 total minus 37, which you can do in your head, but gives us 37,500. So we're going to say paid in capital in excess of par value on the preferred stock, which will be an increase to our equity of 37,500. And then the total amount of cash will increase here by 37,500. I'm sorry, by 75,000. So sometimes I think it's helpful, and I'll just do that right now, to sort of like retranslate all of this stuff into like plain English. So on the first one, what we're saying in plain English, okay, is that the business's cash increased $72,000. And of that 72,000, 60,000 was from the par value of that stock that the business issued, and 12,000 was money that the business received over and above the par value of that stock. In the second one, the business didn't receive any cash. Instead, they received services. Somebody provided services. And so they had an expense of 37,500, but they didn't pay any cash for that expense either. Instead, they issued stock, and 4,500 of that 37,500 was paid for with $3 stated value common stock, and the remaining 33,000 was paid in capital in excess of the par value of that common stock. What's confusing about this one is it shouldn't be par value, it should be in excess of stated value. That's an error that I'll submit to McGraw-Hill. The third one, put in plain English, is that, again, we didn't receive any cash. Instead, we paid for services, 37,500, in exchange for $37,500 worth of no par common stock. And then the last one, we received $75,000 cash. And of that cash, 37,500 was $50 par value preferred stock. And then the additional 37,500 was paid in capital in excess of that par value. So I hope that helps. Par value is confusing, mostly because par value doesn't mean anything. It's just that stock, as a requirement by law, when the company is established, they're required to put a par value on it. And then when they actually sell or issue the stock, they have to list the par value of the stock plus any amount they received beyond that par value. And so that can be a little bit confusing. Let me double check my work, make sure I didn't make any mistakes, because it's easy to do that. It looks like we're all good. So I hope that's helpful. That was number 5 on the week 4, well, not necessarily week 4, but the quiz access for chapter 11.